Your house could be a ticking time bomb. Yup, it's 2008 all over again, but this time it's taking a darker turn. Goldman Sachs analysts are sounding the alarm. The housing market isn't just trembling, it's on the verge of collapse, potentially toppling harder than the cataclysmic crash of 2008. Mortgage rates have hit the roof at nearly 7.5%, and it feels like a déjà vu. But this time, it's a little different. But how did we come full circle, and what makes this downturn even more harrowing than the last one? Well, keep watching as we dive deep into the chilling analysis and find out why the upcoming housing crash will be worse than 2008. Remember the housing bubble back in 2008? Well, home prices are now nearly double what they were when that bubble popped. The Census Bureau just dropped a figure that's hard to swallow. The average sale price in the US is kissing the $500,000 mark. And while we're not building enough homes to meet demand, the ones we do have are struggling to find owners. Things might be turning sour faster than anyone expected. We're seeing signs that could mean house prices are heading for a tumble, and possibly a bigger one than the doomsayers predicted. Demand for homes has taken a nosedive, with mortgage rates soaring past 6% for the first time since 2008. Sales are down nearly 20% from last year, according to the folks at the National Association of Realtors. And rents? They've shot up almost 30%, squeezing people who are already priced out of buying. But there's more to it. We've got a 10.4-month supply of new houses just sitting there, the most since 2009, and we're building more homes than there are families to live in them. Yes, the maths behind buying a house is looking pretty grim these days. If you take the median new home price of about $438,000 and the average hourly earnings, the price-to-income ratio is clocking in at a staggering $16,035. To put it plainly, that's the highest it's been since the dark days of the Great Recession. Bottom line, houses are just too pricey for most working folks' wallets right now. What's with the real estate market? It's hitting the brakes after years of pedal-to-the-metal growth. Opinions are split on where we're headed next. Could we be soaring down the barrel of a 2008-style meltdown, or maybe just a gentle tap on the housing market's brakes? Jerome Powell from the Fed is talking about a difficult housing correction and how we need a better balance of supply and demand to make houses affordable again. And here's something. The slide in prices has already kicked off. The S&P CoreLogic Case-Shiller Index, that's like the thermometer for house prices in big cities, only went up by 15.8% in July. Sounds good until you realize it's actually a drop. Plus, Zillow's own numbers show a dip for the first time in a decade. This could be one of the sharpest U-turns in housing growth we've ever seen. Big city home values like those in Seattle, San Francisco, and San Diego slipped between 4% to 5% just in July. What's causing the markets to wobble? Well, for one, we're seeing a lot more for-sale signs popping up. And only in July of this year, the housing supply shot up to levels we haven't seen since, you guessed it, 2008. So why the sudden surge in houses for sale? It could be that some homeowners are trying to get ahead of any potential drop in their property's value by selling now, or it could be that they just need to sell, period. It's the old supply and demand story. Too many homes on the market and not enough buyers can mean one thing: dropping prices. Let's take the temperature of the market with some expert opinions. Mark Zandi from Moody's is saying we might see a price correction of about 0% to 5% within a year, provided the economy doesn't hit a full-blown recession, which, by the way, is a whole other debate among economists. But here's the catch. A 5% drop is not a nosedive like what we saw in 2008. Zandi's pretty clear. That was a crash, but this isn't looking like one. Aaron Brown, formerly of AQR Capital Management, he's not ruling out a crash. He sees a bit of a déjà vu with home prices climbing alongside rising rates, a classic bubble move. Yet, he's not hitting the panic button, betting on rising rents to keep home prices from tanking. But still, rents did take a tiny tumble from July to August, their first in nearly 2 years. Roger Ashworth, also a managing director at Goldman Sachs, thinks that we're standing on firmer ground today in many respects. There's a big but here. Affordability is a whole different ballgame now. Goldman Sachs isn't hitting the panic button for a coast-to-coast crash, but they are flashing some warning lights for a few cities. If you're in San Jose, Austin, Phoenix, or San Diego, you might want to brace yourself. These markets are sizzling, and not necessarily in a good way. Think of them as the housing equivalent of a hot pot ready to bubble over. But that's not all. It will not get better. Goldman's crystal ball is showing that those interest rates we've all been groaning about, they're likely sticking around, and maybe even taking a step up. The bank's revised playbook suggests the 30-year fixed mortgage could hit 6.5% by the end of 2023. Navigating the real estate market in 2023 might just resemble a game of musical chairs. The music's slowing down, and it's all about finding a spot before the tune stops. September 2022 threw us a curveball we hadn't seen since the 2008 housing crisis. Mortgage rates crossing the 6% mark. That's made quite a few potential buyers think twice, slowing down the whole home buying dance. Let's take Austin, for example. It was the belle of the ball of 2021, crowned the hottest U.S. real estate market by Zillow. A small leap forward to 2023, and it's cooling off faster than an iced latte in a heat wave, slumping to the 30th spot. Homes in Austin are lounging around on the market for an average of 68 days, longer than in any other major metro. But not everyone agrees with the ice-cold label. The local realtors are firing back, insisting demand is still hot. What's the word on the street for 2023? Cities like New York and Chicago might see a tiny dip in prices, under 2%, while places like Baltimore and Miami could actually see prices climb. However, if a city's real estate prices have been playing fast and loose with the fundamentals, they might be in for a rougher ride, with drops of over 25% in places like San Jose and Phoenix. But it's not a nationwide freefall. According to Goldman Sachs, this expected slide in prices should be gentle enough to sidestep any widespread mortgage meltdown or foreclosure frenzy. There's a silver lining. Lawrence Yun of the National Association of Realtors is spotting hopeful signs across the country. He's projecting a relatively steady market on average, with some pockets seeing modest gains and others mild declines. Now, there's no doubt that affordability is taking a serious hit, and it's actually tougher out there for buyers than it was in the pre-crash days of 2006. The Atlanta Fed's monitors are blinking red, showing us that buying a house is getting harder on the wallet, with affordability nosediving way below what's considered reachable for most. They're expected to creep up by about 1.8% by the end of this year, and maybe go up another 3.5% by the end of 2024. So, what gives? Roger Ashworth, a real estate research whiz who's been in the game for over a decade and recently hopped over to Goldman Sachs, gives us the lowdown in his paper with the bittersweet title, U.S. Housing Market Crash Turns Not So Sweet 16. Back in the day, all sorts of mortgage products, like those zero-down deals and cash-out refinancing options, fueled the real estate frenzy. Fast forward to today, and it's a different story. We're not seeing as much of that risky business. Instead, it's all about supply and demand. Classic economics. There just aren't enough homes to go around. Inventory levels are scraping the bottom of the barrel, and to throw a number at you, listings have tanked by a jaw-dropping 60% from 2018 to 2023. The present housing market's challenges and dynamics differ markedly from those that precipitated the 2008 financial crisis. Unlike the previous situation where risky mortgage products and an oversupply of homes were the norm, today's high home prices are a consequence of a starkly opposite issue, a persistent shortage of available housing. This scarcity has been a product of several converging factors. New construction has not kept pace with the swelling demand, hampered by various impediments ranging from regulatory hurdles to spiking material costs and a shortage of skilled labor. The effects of the COVID-19 pandemic also induced a significant number of people to reevaluate their housing needs, leading to an exodus from densely populated urban centers to more spacious suburban homes. Demographically, the millennial generation is now at the peak age for home buying. intensifying the demand for housing. Moreover, the low interest rate environment that prevailed for the better part of the past decade, now giving way to rising debts, has had a dual effect. On one hand, it allowed many existing homeowners to refinance their mortgages at exceptionally low rates, which reduces the incentive for them to sell, further tightening the inventory. On the other hand, the recent hike in rates is sidelining potential new buyers, who are deterred by the consequent higher borrowing costs. As a result, we are witnessing a market where buyers are increasingly priced out, but the limited inventory is preventing the usual market response of falling prices. Instead, there's a standoff with potential sellers waiting for high prices and buyers waiting for prices to drop or their own financial situation to improve. Freddie Mac's chief economist, Sam Cater, highlights that this situation, where rising mortgage rates are coinciding with high house prices due to low inventory, is forcing both buyers and sellers to wait for more favorable market conditions. Homeowners today have higher credit scores on average than they did before the last housing crash, indicative of stronger financial stability among borrowers. This improved creditworthiness reflects tighter lending standards that have been enforced to avoid the widespread defaults that contributed to the previous crisis. In addition to higher credit scores, homeowners have accumulated significant equity in their properties, thanks to the rapid appreciation in home values over the past few years. This tappable equity gives homeowners a financial cushion, which means they're less likely to be pushed into distress and forced to sell if the market cools or if they face personal financial difficulties. While demand driven by the pandemic has pushed home prices up, the current levels of equity mean that even if prices were to fall, many homeowners would not immediately find themselves in negative equity or owing more than the worth of their homes, which was a significant issue during the Great Recession. However, the soaring home prices and consequent buildup of equity might not be entirely possible for the housing market. All these factors could potentially contribute to a housing affordability crisis, especially for first-time home buyers or low-income households who are now finding it increasingly difficult to enter the market. The climb in home prices, coupled with rising mortgage rates, is exacerbating this issue. Goldman Sachs' projection that home prices will continue to increase into the next year suggests that the market might maintain its momentum, barring any major economic shifts or increases in supply. This trend may continue to put home ownership out of reach for some, while others may benefit from the growth in equity, especially those who are not looking to buy for the first time or move. The leverage scenario in the current housing market demonstrates substantial improvements from the conditions that contributed to the previous financial crisis. A critical factor here is also the dramatic reduction in leverage, meaning homeowners generally have a lot more equity in their homes than they did in the years leading up to the 2008 crisis. The fact that total mortgage debt is less than 43% of current home values indicates that, on average, homeowners have substantial equity in their homes. This serves as a financial buffer against falling home prices, because even if home values were to decline, many homeowners would still have equity, rather than falling into negative equity or underwater on their mortgages. And the near elimination of negative equity contrasts sharply with the situation in 2011, when more than a quarter of borrowers owed more on their mortgages than their homes were worth. Today, the vast majority of borrowers have a comfortable equity cushion. ARMs now represent a smaller fraction of the mortgage market and are subject to more stringent underwriting standards. In contrast to the pre-crisis period, when ARMs were a substantial portion of the market and often featured lax underwriting, most ARMs now have fixed rates for the initial years, and borrowers are qualified based on the fully indexed rate, which means they are assessed on their ability to pay even after the rate resets. Although 1.4 million ARMs facing higher rate resets may pose a risk, this number is far less than the approximately 10 million during the 2007 period. This reduced number reflects both the lower prevalence of ARMs and the more cautious approach to mortgage lending post-crisis. Today, we're dealing with a mix of super high home equity, low numbers of people missing mortgage payments, but also homes that are just too expensive for a lot of folks to buy. Homeowners are sitting on a lot of equity, If prices drop, most won't be underwater like they were during the last crisis. Not many people are behind on their mortgages right now, which is great because it means fewer foreclosures and less panic in the market. But buying a home has become a pipe dream for some because the prices are just too high, even with all that equity floating around. In simple terms, we're not on the edge of a cliff like before, thanks to better lending rules and people being more careful with their money. And if we don't figure out this affordability problem, a lot of regular people could be priced out of owning a home, which could lead to a whole different set of issues. Let's hope the market finds a balance that works for everyone. What you learned from this video is of no use to you. If you don't understand, wealth is not a sign of financial intelligence. There are millionaires and even billionaires who have lost it all because of poor financial decisions. The real difference between the rich and the poor isn't the amount of money, it's the mindset, the education, and the choices they make every single day. Do you want to learn this skill too? Watch the video appearing on the screen right now.